Yeah, it's facing the requirement to restore ROE. I mean, as you say, the combined effect of the more capital, the more liquidity, and more funding requirements in total, it can be calculated around 100 billion euros, which is equaling the banking profits back in 2011, that is. So banks, now we have worked with it already in the past 2 or 3 years, so quite a lot have already been done, but still more needs to be done. And the simple effect is we have to become much more efficient in the way we run our capital deployment, our liquidity and funding. And that is not something we can do alone. We can make more efficient processes, modeling, and all sorts of things. But we are actually in a situation where, in dialogue with our customers, we'll have to find a solution to their need, which is less capital intensive than we did previously. And that is actually possible because when we think more about it, we can create better collateral, better governance, structure financing in a better way where we need less capital because the risk is lower, and thereby we can take out some of the cost of the regulation in reality and actually build exactly what the intention is: less risk and more resilient banks. But all banks will have to create sort of a new business model which is sustainable in your environment, which does give a sufficient return on this new level of capital. I think actually it's counterproductive, and I think the analysis in the Liikanen report is very good, but they come to the wrong conclusion, because what we need to do in Europe, we need to bring a part of the financing of corporates in Europe to the capital market, just like they have done in the US. So in the US, 80% of corporate financing is done on the capital market. In Europe, it's only 30%. That means that we have to do more capital market activity. And what is that? Yeah, that's corporate bond issuance and swapping the currencies and the interest rate so the corporate get the finances that the corporate needs. Now, that's a number of capital market transactions: securities underwriting, distribution, swaps, and so on, derivatives. And why do we want to ring fence that? For the customer, it's actually the same as getting a bank loan, and it's getting a certain amount of money for a certain maturity at a certain interest rate. And to do that through the capital market will be the future, because the other parts of the new regulation, the capital regulation, makes it so expensive to put it on the balance sheet. So we need to do it on the capital market, at least the longer maturity parts of it. And that's fine, and we are working on that. But then to ring fence that away from the rest will make it very burdensome for customers. It will be very, very costly. You have to transact with several legal units. And for the bank, and for the customer, we then need to cross-collateralize and cross-governance and all sort of things. Legal setup is complicated, where in reality it's very simple. And the final argument is, of course, that the universal bank in Europe, like Nordea, did not cause any problems. I mean, we didn't have one single quarter with less than 8% ROE. So what is it exactly? Which problem are we trying to solve? One that was not really there. So my recommendation is that you should think there was something on the balance sheets of some banks, which we indeed saw. Yeah, but then we can solve it another way. We can just say we don't like these assets, we think they're risky, so you have to post much more capital, like 50% or 100% ratio, against those risks. Then, of course, they will disappear for the balance sheets, or if they are there, they will be backed by capital. So no need to do all these complicated structures, which, of course, after all, the world is complicated enough. Why make it even more complicated? I can simply not see it. So I would even describe it as somewhat a counterproductive measure. But I think there will be a lot of banking models out there, and I think there will be different banking models that will do very well probably. But you can say the common denominator will be one where they will have a sustainable business model, in the sense that they deliver a result which is higher than the cost of capital, which of course will be needed in the long term, because then they will have a rating and a situation where they can track funding at a reasonable price and thereby service the customers in the real economy. So the denominator is the sustainability of the banking model, but whether it's a universal banking model, which I strongly believe in, a relationship banking model, which I think will thrive, but there can also be others, investment banking models most likely, but also maybe more specified and special banking models and household banking models and whatever. So I think there will be room for a lot of banking models.